Good morning, everyone, and welcome to our special presentation of trading low-price stocks. My name is Raul Aurora. I am the Coaching and Education Coordinator here at Trading Wins. And before you start to worry, no, I will not be the one doing the presentation. It'll be our esteemed head trader, Vince Mora, who will join us shortly. My job is to organize the program for him, get him all the questions that you'd like to get answered, and to make sure that you have a terrific learning experience. The first part of that learning experience is to ask you to make sure that you can hear us and see us. If you can, please let us know by putting in an affirmative note in your chat box, and we will get started shortly. I do see a hey from Kyle in Arizona. Kyle, nice to see you bright and early in the morning, unless you tell me that you're a different part of the world. I'd love to hear that as well. Robin Clearwater, Dimitri, nice to see you as well. John in Ohio, first one in today. Very nice to see that. Randy in Iowa. Vera in Vallejo, and Melanie in Plano, Texas. Melanie, always a pleasure. Vince, good morning to you. We've got a busy session. I don't want to waste a lot of time on the administrative stuff. How are you?
Good morning. I'm doing well. A little under the weather, but otherwise, looking forward to this.
When we convened for our Monday night session, you were just starting to get the beginnings of a cold. It looks like it's gotten worse.
Yeah.
Hopefully we'll get through this session without any trouble.
Yeah,
for the folks that are joining us for the first time, we like to have as I said, we'd like to give you a great learning experience in these sessions. And the best way to do that is for you to ask questions. And the way to do that is to put the questions in the chat box that you see where you're putting your comments now. And we'll do our very best to get to each and every one. Vince, as he starts a session, will let us know how he wants to handle the questions, whether it's at the end of each of the segments or throughout the session, or perhaps at the end. We'll let him get to that. With that being said, Vince, let's talk about trading low-price stocks.
Yeah, great. And before we get there, I do want to encourage everyone to ask questions along the way. This is I want you to get as much out of this as possible, so don't hold off on your questions. Raul, if you can monitor them, I'll try to do the same and answer them as we go through. But I thought this would be a good topic to discuss because most of us start out with a small account, and so we don't always have the luxury of trading some of the bigger names out there. And regardless, there's some real opportunities with the lower price stocks. I mean, a stock like Amazon doesn't get listed at $1,000 a share, right? It was once a low price stock as well, and so the question becomes, how do we identify the next Amazon, right? And we can try to do that through news. I mean, we'll take a look at a number of cannabis related stocks now. That seems to be the hot item right now. So many people are after the next hot cannabis stock because, as you know, it's being legalized in many countries, and so it's the hot topic right now. And so part of that is, how do you find that next gem compared to other players in that sector that are useless and will never make money? And how do you find that next big opportunity, that next big run? When people think of smaller price stocks, many of them think of the penny stocks and the pump and dump, right? There you get a symbol that's promoted, it jumps up and then it just collapses a couple of days later, and that happens quite a bit. But how do you find those companies that do have some longer term opportunities? And that's what I want to really cover here today.
All right, first question. Elizabeth from Scarsdale asks a really good one. She says, will the session be recorded? Elizabeth, yes, it will be. It will be available in your members video section by the end of the day today. All right, Vince, let's get going.
Okay, so let's talk about trading low price stocks. And before I go any further, I always do need to remind you, please don't trade with real money until you're completely comfortable with the system you're trading. We always talk about trading risk-free. We always want to trade risk-free. Well, you can do that at the beginning. Trade, a paper money account. And it may not be the same from an emotional standpoint, but until you really find your comfort zone, I encourage you to do that. Okay. So, today I really want to take you sort of from the beginning stages. In other words, how do you build your watch list, let alone find something to trade. And then once you do find something, what do you want to look for? How do you track it? And how do you stay in that stock? So we'll go through a simple technique like we talked about in the free session, the guppy technique. I'll just go through that again. And then I want to give you a few different scanning tools. Actually, I'm going to give you 4 different websites that you can use that'll help you identify the shorter term and the longer term opportunities. And then we'll go from there. We'll actually try to find a couple today with you. So the guppy method is basically a bunch of moving averages. It's a group, a bunch of shorter term moving averages and a bunch of longer term moving averages. I won't spend a lot of time on this, but I do want to put up here the ones that you should be looking at if you want to set up your screen. Some charting platforms will have what they call a guppy or a GMMA indicator that has all of these moving averages in one indicator. Others, you will have to go in and put these moving averages on individually. Now, these are all exponential moving averages. So the shorter bands are 3, 5, 8, 10, 12, and 15. And the longer term are 30, 35, 40, 45, 50, and 60. Okay. And basically, this is what they look like. I've got the shorter bands in blue, and I've got the longer bands in red. Okay. Now, how do you trade these and why? And why am I using this system? Okay. First of all, I do want to say you don't have to use the guppy method. You could use the winning momentum strategy. You can use your own strategy. You can use whatever you like. To me, this is just a very, very simple strategy that helps you identify those breakouts. An easy visual way to identify a breakout is when price moves from within the bands to completely, one side of the band, either fully above both bands or fully below both bands. That's a very simple and easy way. So even if you're not very familiar with technical analysis overall, this is a very easy way to get started. There's a number of ways you can trade with the guppies. You can wait for that period in time when the blue bands move to one side of the red bands. In other words, they either break above or they break below, and they are all stacked properly. You'll notice that the best trends or the strongest trends are when you can actually see some space in between each of those moving averages, both bands, okay? And when they're both sloping in one direction like that, those are your strongest trending periods. Now, what we want to try to do is identify the starting point for that, right? We want to ride that wave. And so there are certainly ways to trade within here, but first and foremost, we want to find a way to identify when this is about to happen. Okay, so when you get a period of consolidation like this, and this is really the starting point with this type of strategy, and the longer this goes on, the better it is. And whether it's on the daily time frame, the monthly, a 1 minute, a 3 minute, really doesn't matter. The time frame that you trade is your preference. Okay, and I always say that really depends on how much time you have to devote to your trading. Okay, so what we want to do is identify a period of consolidation, and it's easily identified with the guppy method because the bands, both the shorter term bands and the longer term bands, are all overlapped, right? They're all one on top of the other. And so it's a very, very easy way to identify a period of consolidation or a channel, if you will. And then you wait for that period where you get some separation. Okay, so you can use this in a few different ways. Number one is waiting for price to clear both. Okay, that could be an entry on itself. It's not the way I do it, but that alone could be a way to do it. Where I would use that method is when both are trending strongly, such as in here, and say price moved back within the bands, within the blue bands, and then pop back out, there I'd be very comfortable taking that trade because you already have a strong trend in place and you have strong momentum on your side. So this pullback into the bands and then popping back out can be very, very effective, okay? But your starting point is when price clears both of those sets of bands. Secondly, it's when it does that and clears a previous high, or especially the high of that channel. So if you go back in here, and this is a Leafia, this is one of those cannabis stocks that recently just took off. This is a daily time frame. And you can see that it consolidated over a few months. And then, out of nowhere, it popped out of the bands. Now, that should have been your heads up to begin with. But at that point, we didn't really have a lot of momentum behind it or a clear trend, right? Until we cleared a more significant high. So initially we cleared the high of that channel and we broke out. And then we cleared this high here. Okay? And not only that, we came back to retest it, right? And where price went in the bands and then popped back out, okay? So as always, there's an aggressive approach and there's a conservative approach. The aggressive approach is taking the initial break of that consolidation period, right? And that would have been the very start of that move. Okay? If you want to be a little more conservative, you wait for a more major high when you have some slope on the bands. So now, at that point, when it broke this high, you could have said, well, now all the bands are stacked appropriately, the shorter time frame over the longer time frame, and we have some slope. So now I have more of a trend in place and I have some momentum behind that move, right? And then as you go on, you can just take the break of every high if you wanted to, or whenever price moves into the bands and pops back out, you can take that and just ride that wave. It's very, very simple and easy to follow, okay? Now, when it comes to low price stocks, and especially if you're talking about penny stocks, which we usually refer to anything under $5 as a penny stock, when they make these moves, especially if there's a story behind it and they're in the news a lot, they might make a very, very quick run and then fall back and settle down just as quickly as they moved up, right? So you want to scale out, you want to have a plan to take profits along the way. Now you could use, as always, your Fibonacci levels to identify overhead targets. If this was a recovery story, for example, if price had been up here and it fell apart and then consolidated for a period of time and then started to recover, there would be previous highs, back in here where you could use as targets, right? Or just on every, use price action. So in other words, this is running higher, and as long as you're not getting a close below a previous low, you're good to stay in it. But as soon as you get a close below a previous low, that's when you should consider at least taking part of your profits, if not exiting the full amount. Now, the real benefit here is that you're risking very, very little, but your potential return is huge. Now, they're not all going to become the next Amazon, but there is that opportunity. But usually, when these make a run like this one, going from about 50 cents or so when it was consolidating down here to over $3, that's many times your money, right? But initially, getting in here, all you're risking is the 50 cents. And more often than not, you're not even risking the full 50 because this isn't necessarily going to go bankrupt tomorrow. It may pop up and move back and then just continue to consolidate. So, you always have the chance to get back out of it near 50 or 40 or 30 and just lose a few cents. The other benefit is that you don't have to buy an options contract if this is only 50 cents. And that way there is no expiry. You don't have to time the trade. You have the luxury of time on your side to sit in there and watch it go, as long as from a technical perspective, it's doing what it should. And then, of course, something that I don't often talk a lot about is incorporating the fundamental side of trading with the technical. In other words, one way to separate these smaller price stocks, the good ones from the not so good ones, is to actually look at some of the fundamentals, right? Are they making money? Are their sales increasing quarter over quarter? Are their earnings increasing quarter over quarter? Those are the types of things you want to look at to see if this company is for real or not. Okay, and those 4 websites I'll give you is really all you're going to need to identify some of these and get all the data that you need. Okay, let's try to answer some questions because I see a few were typed in before I go to the next piece here. So we have Elizabeth saying, so after the pop out, would you take the price above that? Yeah. So for example, Elizabeth, if we zoom in on this section here, the consolidation zone, right? You see how it's moving back and forth, right? Now, if you just take the move above the bands, okay, you may run into that several times here if you look at this, right? And it really doesn't go anywhere. That's why you want to wait for the break of the high of that range, okay? But for example, this candle here, it was really this little one here that cleared the range, right? This one did intraday. This one closed out of the range, which is what you want to see. So the way I do it is then I mark the high of that bar, okay? And if I get a trade above that, that's when I'm in, okay? So that's the way I would do that. Let's see, one is saying, came in to learn, where can I find the study Vince is using? One, these are just moving averages. Some will have it as an indicator. Some platforms will have it as an indicator, and it'll be known as the Guppy or the GMMA indicator. But really, these bands, they're just moving averages, okay? And let me just put this up quick. Well, we'll send you the recording of this. At the beginning of the recording, I put up a slide where I showed each of what these are. They're all exponential moving averages and the settings for them, okay? So you'll be able to get it from there. Let's see what else there is. Raul, if you can help me read off the questions.
Of course. New York says, Vince, do you have a certain price range that you're using this strategy on? For example, stocks between 50 cents and $2, etc.
I really look at anything under $10, but I have 2 ways of doing it, and I'll show you as we go through. There's one where I look at some very, very low price stocks. I'm talking a fraction of a cent, okay? The over-the-counter, the pink sheet, true penny stocks that most people wouldn't look at, and they really shouldn't in most cases, but I'll show you why I look at those and which ones I look at. And then there's the ones that are somewhere between 5 and 10 that actually have options and paid dividends, and I'll explain why I use that. Okay, I'll get to that shortly.
Richard in Louisville says stockcharts.com calls it the moving average squeeze. Vince, are you familiar? You're a stockcharts.com.
Yes. Yeah, that's fine. So each platform might name it a little differently. It's just a group of 2 groups of exponential moving averages. Thanks for informing us on that.
All right, let's keep moving.
Okay. So let me just go over here. The other thing is when you get the bands crossing from one side to the other. So here, obviously, this is a newer issue. Okay, it doesn't have a lot of history, and as soon as it was released, it consolidated, and then they just separated. But if we look at any other stock or even an index, let's go to the S&P 500, you'll see that the bands can cross, right? So when you get an area like this where the blue bands come into the red or below it and then cross back above, again, when price clears them all, that could be an entry. Now, I actually had a couple of email questions, and one of them had to do with this. So let me just go back here and answer them. One was from Dimitri, and I believe Dimitri's with us here today. He was asking for me to confirm the bands, and then he was saying, could you use just one of those bands as an indicator? Treat each of them as one indicator. You can actually, Dimitri, and if you're going to use just one, I would use the red one, which is the longer term moving averages, okay? If you look at this here, the longer term, these are the ones where a lot of times price will approach it and bounce off it, approach it and bounce off it, approach it and bounce off it, okay? As where the shorter term bands, price will sort of fluctuate back and forth from one side to the other. You can use it just the same, right? So if price pulls back here and then pops back above, you can take it. But the longer term ones are smoother, right? It's like looking at a weekly chart compared to a 1 hour chart. The weekly is obviously going to look a lot smoother, and it's going to be much more predictable. It's going to have a stronger trend in place, a longer term move. And then you just wait for these pullbacks to bounce off the longer band. So if you were going to use just one, I would personally use the longer time frame one. Okay. Now let's go back here, because the other thing that you want to use is basic price action and trend lines. Okay. So throughout this consolidation phase, if you want to identify a point where you might be breaking out, okay, you can use price formations, right? Like a bullish engulfing pattern, right? Which is a reversal pattern. So here, you had this big green bar that completely engulfed a much smaller bar. That was a heads up that we might get a breakout. Okay. You can use trend lines, which I would highly encourage you to use trend lines, even just to mark the highs. Okay. And then when you have some history here, connect lows to lows and highs to highs. They will always predict future levels of support or resistance. Okay. So you always want to use those, and they will make it very easy for you to identify breakout points. For example, if I clear all these drawings, whenever you have a pivot high or a pivot low, okay, and what I mean by pivot highs and pivot lows, and I know some of you or most of you know this because we've covered it in other classes, but just bear with me, right? These peaks, these turning points, the highs are pivot highs, okay, and the lows are pivot lows. So what you want to do whenever you identify one of those is just draw a line across. So mark that spot and draw a line across. Even if we were just here and there was no other bars to the right of it, once this puts in place, draw it, and at some point that's going to become either overhead resistance or support. You do the same for the lows, and along the way you do the same. Okay, that'll really help you identify those breakout points. They're very simple. So for example, you had a previous high like this, even if you had missed this whole area, but with the bands stacked nicely one above the other with space in between, which means you've got a strong trend, strong momentum in place, and you just mark that high. As soon as price breaks it, there's a real strong chance that this is going to continue to go higher. Okay, so even catching a portion of that move can be substantial, especially since the price point that you're getting in at is very small, right? You're not taking a whole lot of risk at all. And when you're connecting lows and highs, you do the same sort of thing. So for example, once you had a low here, and you had a low here, for example, you connect it, and that way you can see now we're retesting that level, and maybe we're going to bounce here and go higher. If we break it, that trade is completely broken. At least that's an area where you can exit. You can use these trend lines in many different ways, but you should always get used to drawing trend lines. Okay, you want to connect at least 2 points. The more points along the line, the stronger that area is, for support or resistance at some point. But mark the highs and the lows and connect lows to lows and highs to highs. That's all you have to do. Okay, very simple. Now, how do we screen for these? And why do we want to trade these low price stocks? Okay, let's go to those 4 websites that I was talking about earlier, and we'll go through each one. The first one you've heard me talk about before is Finviz, finviz.com. It's a free site. You can register. They actually have a paid portion, but I don't use it. I just use the free one. They have here a screener. Now they have a bunch of things. First of all, there's one tab called Groups. If you go to Groups here, it'll give you the sectors, right? And they have a 1-day performance, 1 week, 1 month, 3 months, etc. So by looking at this, you can tell which sectors are sort of the main ones in play. So for example, if we look at utilities and we go 3 months back, utilities was down here, wasn't doing a whole lot, right? You come up here 1 month and now it's performing a little better, right? It's moved up in rank. You go to the 1 week and it's at the top, right? So this one's going to be getting more stronger and stronger. So what you want to do is go to the utility sector and search for stocks in there. Same with, healthcare was high on the list back here. They were moving really well. Generally, what happens with a sector like that is you get a few of the bigger names that start going on a run, and then the smaller, lesser known names will follow up. And so once you identify that a sector is getting more and more popular, it's performing better and better, there are laggards in there that you can identify and trade. Okay, but if we go to the screener tab here, there's a descriptive screener, fundamental, a technical, and you can click on all. Okay, now I like this one because first of all, it gives you a ton of things that you can search for, but you can also, on the free one, as long as you register for an account, but it's the free account, I mean, you can save your screens, so you don't have to create it every time you go in there. Now, going back to Spiros' question, there's a couple of different things I do. There's a very simple, new highs under $10, right, that I put on. So I go to price and I say under 10, and you can do under $1, under 5, and whatever you want. But, I choose under 10 here. And then for the 52-week high low, I just put new high. Okay, and that'll give me a list of stocks making new highs under $10. So if I go to these charts, right, and one quick and easy way, first of all, if you hover over it, it'll usually show you the chart. But these tabs over here, right along here, if you go to charts, it'll plot all the charts up. So you can quickly have a look and see what kind of high it's breaking. So you see LSCC here. Looks like there was a nice trend, right? It had a recent pullback, and now it's breaking out to new highs. And it looks like on this chart, that might be an all-time high. So very, very easy, inexpensive stock breaking out to new highs, during the trend. Of course, you want to put it on with your guppy bands and make sure that the blue is above the red and stacked appropriately and, has a nice strong trend and all those things. But this is a very quick and easy way to just find those ones going off to new highs. Now, the other thing I would do to try to separate sort of the stocks that might just be on a run because they're being promoted compared to the ones that actually have some real potential behind them is to use a couple of different settings in here. And here's where the fundamental side comes in. If you go to the right, to the far columns on the right here, the two columns here, there's an EPS growth quarter over quarter. I would just select positive, meaning I'm not stipulating how much growth. I just want to see that there is growth quarter over quarter. Same with sales. Go positive, greater than 0, quarter over quarter. Okay, and every time you click on a column and you update it, it's going to narrow the focus, narrow the number of charts that it selects. Now I'm going to get rid of new high, just put any there, it doesn't matter. And if you're using the free version, you're going to have to put up with those ads and those videos popping up, but it's a little annoying, but you can deal with it. And then, so if we let's go to overview here so we can see how many we have. You see, just by putting quarter over quarter growth for EPS and sales and stocks under 10, you can see how many we come up with, 333. Okay, that's way too many. Obviously, we want to try to narrow it down. So one of the things we can do is, first of all, go up here, make sure we are on US only. It depends, you can pick whatever country you want, but I trade US, and then introduce volume. So if we say, over 500,000 shares, well, that narrows it down. It brings it to 82. If I say over 1 million, because obviously the more volume there is, the better. It brings it down to 42. Okay. We can look at relative volume and say over 1.5. So if it's getting more and more volume now, that'll show it. And there we go. We're down to 10 tickers, right? So now we can either just go to the charts tab and look at them all, or we can also go to a tab called basic. And the reason why I like the basic tab is because beside each chart, it gives you some stats, okay? And the key ones you want to look for are, you want to see if they're paying a dividend, how big of a short float there is, the average volume, and so on, and exactly what kind of growth they're experiencing. Okay, in one snapshot, it's all there. If you click on the name, it'll take you to the company website, and you can find more details on it. You can also see a quick snapshot of the chart and whether it's something you want to trade or not, right? This one certainly doesn't excite me, right? It's dropping like a knife here. But this one, DNR, looks like something I'd be interested in, okay? And then you shorten your list that way, and you build your watch list, okay? Now, we could have said, under $1, right? Or if you have a bigger account, of course, you can do higher price stocks as well. This works just the same. But one of the things you want to check for if you're trading some very, very small price stocks, okay, is their shares outstanding. Some of them will have a huge float, and if it's huge, you could be in for a reverse split at some point, which kind of defeats the purpose. So one of the things that I really like about trading what I call penny stocks, which are less than $1. Okay, so if I'm going to pick up something for say 11 cents, I'm going to buy a ton of shares, right? I might buy 100,000 shares. So if that thing goes to $1, it's a windfall. If it doesn't, I'm losing very little. Okay, but if it does a reverse split on me and my 100,000 shares become 1,000 shares, then it kind of defeats the purpose, right? So you want the shares outstanding to be a reasonable amount, and generally, nothing more than 100 or 200 million is what I look for there. Okay. Now, one other screener, going back to that question from Spiros, is this one: optional dividend paying stocks under $10. So this is what I click on. I put dividend yield positive, meaning I'm not stipulating how much of a dividend, but it has to have some kind of dividend. Under $10, optionable in the US, okay? The only other fields that I have on here is the 20-day simple moving average being above the 50 and the 50 being above 200. So what I'm trying to do is find ones with some slope already in place that are still under $10, but have a dividend and have options. And the reason why I'm looking for these is because I can do a married put situation on these, okay, for pennies of risk. Okay, so let's look at ROYT here and see. So first of all, shares outstanding only 38 million. So I like that. It's in a trend. It looks like it's breaking out to new highs here, right? Which are most likely all-time highs. They pay a dividend of 49 cents. Okay, they yield 17.5%, which is good. And let's go back here and see if the options are tradable. ROYT. Okay? That was the symbol, wasn't it? Let's go back. Yeah, I think it was. Yeah. So let's go back here. There it is. So let's go out as far as we can to March and see if we can do this. So the stock is $2.85, right? Now the spread's kind of wide here, but you look at the 250 here, very inexpensive. So 250, 285. So again, if I'm paying 285 and then paying another 25 cents or 20 cents for that option, right? I'm getting at like 305 total cost. My out is at 2.5. So I'm risking maybe 55 cents on that whole position, right? But I can hold it until March. I can just buy the shares. That way I don't have an expiry date to worry about and go from there. I'm collecting a dividend and so on. But if there's leaps, because generally that's what I look for, leaps where I could lock this in for a very small risk, but carry that dividend, okay, and just sit on that position and hope both for appreciation in the price while I collect that dividend. Okay, that's why I do that screen. And, if this ends up being the next Amazon as it moves higher, you roll out the options and you just continue to hold that stock and collect that dividend, etc. Okay. So, and Karen is saying that ROYT is also in a bullish sector in oil. Yeah. And so you can start by looking at the hot sectors and working backwards that way. You could just start with a scan like the one I gave you here. Or you can just look for stocks under 10 breaking out to new highs and go from there. It's however you prefer it. I'm just giving you different options, okay, to use. So it's very simple. Another great screener is with Yahoo Finance. If you go to Yahoo Finance, and you'll find it at finance.yahoo.com and hover over my screeners. You can go to the equity screen. I mean, you can look for ETFs, futures, indexes, whatever you want. I like to use equity and put in, again, the price, the sector if you want. By adding filters, they have all these filters. You can go to volume, you can go to the earnings, whatever you want, whichever one you're more comfortable with. I'm giving you options, okay? So Yahoo is also great for news. They have up-to-date news. If you want to go to those penny stocks under $1, okay, you want to look at the over-the-counter market or the pink sheets, as they call it. If you go to otcmarkets.com, overthecountermarkets.com, okay, here, there's a stock screener right here. And this is another good one if you just find a symbol and you want some stats on it, like UBQU right now, which is in the cannabis space. And I know it's called UB Tech, I can't even pronounce it, Software Corp. I know it doesn't sound like a cannabis related stock, but they have investments in the cannabis space. You just get an idea. And well, this one actually, yeah, down in here, I believe, yeah, there's stats down. Maybe that wasn't a great example. Usually they have more data on oh, there we go. Click on financials. My mistake. Go to financials here once you put in that symbol, okay? And it'll show you, the last 4 years, right? So is there a trend? See how their revenue in 2014 to 2015 to 2016, 2017, how it's growing, right? Same with their gross profit. So you get to see whether they're actually making progress or not, right? So is this maybe going up because it's being promoted, or is there, substance behind this? Now, this one, from a chart perspective, it's not moving yet. If we look at UBQU, it's really not doing anything yet, okay? It doesn't have options, but who cares? You can see it's just been dropping, right? But if this were ever to break above, you see how here the blue bands broke above the red, and then it just took off. So down here, you could have been in this one at a fraction of a cent, right? 0.007, and it went up to 2.5 cents, right? It doesn't sound like a lot, but when you pick up a lot of shares, it makes a big difference. And I'm not interested in going from, 0.007 to 0.02. I'm looking for that next one that becomes, $4 or $5, maybe $8. Look at IGC here. What's happened recently? This is again in the cannabis space. Okay. Here's that pattern: consolidating, right? It breaks up above. Now, if you just took the break of the high of this consolidation period, you'd be in somewhere here. Okay, if you missed it and it pulled back and then price broke above the bands here, or go as conservative as you want, break to the high. You got in at just over $2 and you're sitting at, it hit a high of 14 and a half. This in the span of, what was it, less than 2 weeks, right? A little over a week, going from $2 to 14. They don't all do that. But after consolidating this long, when they break out, there's a reason for it. And if there's volume behind it, okay, something's going on and you don't care what it is. You just want to identify that starting point and jump on it. The key is that if we zoom in here, okay, when it broke out here, it was in the 50-cent range. So how much am I risking by buying some shares at 50 cents, right? Max, I'm risking 50 cents, but, has a low of 36. If this turns on me, I'm going to be able to get out even above 36. So realistically, I may be risking 10, 15 cents for the potential of a run like this, right? Plus, I don't have any expiry date on here, right? So I can continue to let this run, okay? Raul, let's answer some questions.
Elizabeth says, Vince, do you put volume on your charts? She had a couple of other questions as well. So would you buy the put as insurance, going back to an earlier comment that you had made?
Yeah, you can. And here's volume. For these, I would put volume on my chart. And you notice that there was really nothing throughout here, but suddenly when it broke out, we started to see some volume, right? Now, volume isn't the reason why I get in, but when you see this start to move and you start seeing more and more volume in, what happens with these low price stocks is that when there's a spike in volume, there's more talk of these. There's people that watch penny stocks that look for trends in volume. And so they'll get more and more attention, okay? Here's another website for those of you interested in following different discussion boards and so on. If you go to investorshub.com, yeah, there's going to be all these ads. This is the hot thing right now, cannabis, but it's not just about cannabis stocks. What you want to do is go to boards, go to stocks, okay? Or you can go to the hot ones, and I would look at the breakout boards or the most read boards. So if you go here, there's just people posting stuff, but you get an idea of the stocks that a lot of people are discussing right now. So I would never jump in just because someone on here says, hey, I think MNGA is going higher, right? You want to look at the chart and decide for yourself. But it's one way to see what's being discussed out there and, look at the chart and see if it's about to take off, right? But, when you can pick up something for a fraction of a cent or a penny and a half, for example, how much risk is there, right? So if the chart is telling you, if a chart is telling you that, hey, this looks like it's going to break out, right? Who cares why? Whether it's just because a bunch of people are discussing it on a discussion board or whether there's actually, news behind it, we don't really care. But if I can risk a cent and a half, and have this turn into 10 cents, 20 cents, a buck, $3, it's a windfall, right? And so, I'm not saying put your whole account in there. Obviously, you want to follow your money management plan always, okay? Take a very small portion of your account and do this, but you really only need one of these to take off and it'll make your year, okay? So have a look at this stuff.
Spiros, New York says, Vince, another question. I'm assuming that a lot of these stocks must be fast moving. How do you set your stops?
Well, that's interesting. The one thing I would tell you about that, and it's a great question, what I would say is don't be greedy. So when you see this and you see this move, like I always say, if there's a gap, right, I'll take my profits or at least a good portion of them. For these, it really, really, messes with your head because you see a jump like this and you think, well, I got in at 50 cents at 2.5. I made my money 5 times over, right? But what if it goes higher? So if you had sold out at 2.5 and made 5 times the money you put in, but you saw it go to 15, you'd probably be kicking yourself, right? So the key is not to kick yourself, first of all. Don't be greedy. You don't know how high this can go. But since you're only risking that 50 cents to begin with, A, you can take a part of those profits when it makes that first move. But B, you can follow this along candle by candle and just wait for a close below a previous low. Now, sometimes you'll end up giving up half your profit. These will come down as fast as they went up, right? But still, if you got in very low, you got very small amount of risk, and you can set your fibs also. Don't be greedy. You'll never catch the top, just like you'll never catch the bottom. Just worry about getting a piece in between. That's all.
Juan in Middletown says, Vince, let's say you pick up 1,000 shares of XYZ at 25 cents. How big a married put position would you open? Is there a ratio that makes some sense relative to the stock price?
No, it always has to do with your account balance. So you want to follow your money management rules. So you never want to overload on one position. Yeah, you may be taking a small risk, but always make sure that risk is in line with your full portfolio. So if you're going to say, hey, I'm never going to put more than 5% in any one trade, then that's how you're working backwards. That's what you're calculating. Just because it's an inexpensive stock, right, doesn't mean you can put half your account in there and hope it goes from 50 cents to 14 bucks and, become a millionaire overnight. That's not what this is about. Take a very small portion, follow your rules, and be patient, because you will hit these just out of sheer luck every once in a while. But if what you're following are technical signals, right? And if you're separating the weak ones from the stronger ones using earnings growth and EPS growth and so on, revenue growth, then you're giving yourself a bit more of an edge.
Kieran, our friend in New Jersey, says, Vince, are you saying that the setup is the candle that clears all the moving averages, or the candle that closes above all the bands?
Or the candle that closes above all the what? I didn't hear the last part. The bands. So you can do either way. You can take the candle that closes above all the bands. That's one thing. And I would always mark the high and go from there. But through the consolidation zone, I like the one that closes above the high of that consolidation zone and then go from there. Okay. But you'll find yourself using different approaches, because initially you'll look for the one that closes above the high of that consolidation zone. Then once it takes off and it pulls back, now here you'll take the one that closes above all the bands, and then you'll take the one that closes above the high. And so you can add to your position along the way as well. It depends how aggressive you want to be with this, right? But if you see this really starting to move and it pulls within the bands and comes back out, you can jump in with a bit more, etc. So there's many different ways you can do this.
All right, Richard, who wins the prize for the best city name, Hot Springs Village, says, Vince, will a trailing stop work? Will a trailing stop loss work with these stocks?
It may work. What you'll find is a lot of these intraday, you see how big some of these candles are and the swings are? What you'll find is you'll probably get stopped out with a trailing stop intraday on some of these. So, which is okay as well. As long as you're making money, that's okay. Okay. As you make more and more money and your account grows, what you're going to find is that you're willing to sit through these a lot longer. In other words, if I get in at 50 cents now and this thing goes to $1, okay, I've doubled my money. But now that's not really what I'm looking for. At the beginning, yeah, that's what I was looking for, to try to help me build my account. But now I'm looking for the lottery pick here. So I'm willing to sit in it a little longer and watch that dollar go down to 50 again and give it up. But the one that does this, that's what's going to make my year, right? So you'll find that as you build your account, you're going to treat it a little differently, most likely. But do what's comfortable for you. That's all that matters.
Dimitri was asking, is there a way to set up alerts to alert you on the crossover of the bands?
You can, and it depends on what platform you're using, but you can. Some platforms do offer alerts, and what you want to do is just take that higher band And say when price moves above, the 3-period moving average, for example, that's your alert, because if it moves above that one, it means it's cleared them all in most cases, right? So, but there's really no substitute for looking at these manually. So at the beginning, go through the charts manually as much as you can. Okay.
Juan Middletown says, Vince, this has been a real eye opener. Thank you.
I can't stress enough the importance for all of you to stick to the basics at the beginning. Okay. Even without these bands, if you just start out with pure price action and look for breaks of highs, or look for patterns, for example. Okay, let's what can we choose here? This is maybe not the greatest example. No, let's see, what's another stock? Let's look at this one. So this was another one in that cannabis space that recently broke out. Okay, so you're trending lower, suddenly we cross and we clear the bands, right? Now, the other thing is there's a big high right in here. So you want to be aggressive. At this point, it ended up being really the same level, because this is the bar that cleared all the bands. So you want to mark the high. It actually ended up being pretty much the same high as the previous high. Pulled back, came in, and there's that move. Now, if we look a little closer here, okay, here's that 3-bar pattern that we always talk about, right? That smile pattern, where you have the middle candle with a lower low than the others. That in itself is a pivot, right? You make a low and then you make a higher low. That makes this a pivot. When you clear high number 1 here, that's your level. So there were 3 different things telling us that a cross of this level would result in that move, right? So these are the types of things you want to look for. Pure price action, basics, draw trend lines, just stick to the basics. Okay, if you had drawn a trend line across the highs here, okay, let's say just going this way, okay, and drawn across the highs, right? This is the one where we touched the most number of points. Well, we broke out here, we came back to retest it, and we held. Yeah, we would have had to sit through it for a little while, and there's no reason to do that, because the bands tell us that, hey, the short term are still below the longer term. There's no reason to get in here yet, but it would give us a heads up. Keep this on your watch list, because if this turns and continues going higher like the trend line told us it should, right? Now we've got a heads up. We can get in a little earlier. You maybe could have taken a piece here, at 6 or 7 cents, and then added the rest once we broke out here, which would have been at 10, 11 cents, and then off it went to 28. Now you see how fast it pulled back, but if you got in at 11 and it went up to 28, 29 cents, what is that? Almost 200%. Why not take your money and run, right? Nothing wrong with that. Quickly, one last thing, because I do have to go. I apologize. We can actually, if there's more questions, we can take these up at another session. But I had gotten an email from Rob, who had asked me how to compare one to another from a technical standpoint. You want to look at the same things we always look at. You want to look at the cleanliness of the chart, right? How strong of a trend you have in place, how much momentum there is behind one, and compare each of those components. You want to look for price chart patterns, right? So within these, whether they're an 8-cent stock or whether they're an $80 stock or an $800 stock, you might find a double bottom here, a reverse head and shoulders, anything like that will tell you that this may start to run. So you want to compare all of those pieces. Start with the basics, right? Trend and momentum. Look for breaks of highs. Look for the slope on your moving average, whether you're just using a 20 or you're using all of these bands, whatever you're comfortable with, and compare each item. The cleanliness of the chart, right? Generally, you want to see charts that, where the price bars are more or less the same size, mostly bodies, not a lot of wicks and tails, right? Because that gives you an idea of volume. look back in here, very, very choppy kind of action, right? All throughout. When it started to take off here, you can see, excuse me, more volume came in and the bar started to clean up. Now, when they're low price stocks like this, it's going to be a little more difficult to find such clean ones. But if you're dealing with the $6, $7, $8 stocks, it becomes a little clearer. Okay.
Sam in Katy, Texas, I do like your question about adding to your current position. Sam, would you mind bringing that up in our market chat tomorrow morning, 10 a.m. Eastern, 7 a.m. Pacific? For those of you that recently became members, we do have a market chat coming up in approximately 23 hours from now. Vince, I know you've got to get going. That was our trading low price stocks. Questions, concerns, follow-up comments, please send them to info@tradingwins.com. We'll do our best to respond to each and every one.
Sorry to jump in. Let me just answer one more question from James. He says, you normally use simple moving averages. Why are you using exponential for low price stocks? Because, James, we want to identify that move or that potential move as early as possible, and the exponential ones react a little quicker to price than the simple ones. So again, you can use simple if you want. We're trying to get in as early in the move as possible, and that's why we use exponential. Okay. Thanks, everyone. If there's any other questions, send me an email, info@tradingwins.com.